All right, welcome everybody. Today's speaker is up on the screen. He doesn't have his institution, so I will tell you that he's a newly minted assistant professor at Stern School at NYU. And Adam, welcome. He's going to talk to us about, well, catastrophic climate risk and the limits of private markets. Thank you very much for coming.
Thanks, Peter. Thanks, everyone. So I think the original plan was for me to fill up something like 30 minutes and then have questions after. But I've also, I've done a sort of condensed version of this so that if we want to go into more details after 30 minutes, we can do that. But also just please ask questions right now at any point, whenever you like. Great. So as I definitely don't need to tell this audience, there have been some issues in home insurance markets in the last couple of years. So these are just, a smattering of headlines taken from around the world. This is, for example, flood risk in the UK causing homes to become uninsurable. We have a similar situation going on in Florida due to hurricane risk, Missouri because of earthquakes, and this top headline here is actually going to be very pertinent to the setting today, which is cyclone risk in Northern Australia, also causing issues in terms of unaffordability and unavailability of home insurance. So, this is all to say climate risk is causing insurance markets to have problems, to collapse, to be expensive, to not exist. The question is why? And to try and understand what the problem is in the insurance market, I think it's worth starting with just a sort of idealized version of what does a well-functioning insurance market look like. So I've drawn, potentially the different layers that in an ideal insurance markets all assume some of the risk. So obviously we start with a bunch of households who face some sort of, in our case, it's going to be natural catastrophe risk. And they all go to an insurer, buy an insurance policy. And the insurer works by diversifying any idiosyncratic risk across those households. Some households are going to make a claim, some are not. The ones that do end up being, getting paid for by the ones that don't. And an insurer manages to pull all those risks and therefore make everybody better off. But there are going to be some risks, specifically correlated shocks, natural catastrophes, that it's hard for a particular insurer to diversify across people. And so they can go to the reinsurance market, the insurance market for insurers, to try and diversify, the reinsurance market implicitly is adding value by diversifying across insurers in different countries, different regions, or who face different risks, and who therefore could sort of diversify across each other. And then the final layer is that even if you take all the natural catastrophe risk in the world and diversify it with Swiss Re or Munich Re, it's still relatively correlated, especially something like Florida hurricane risk. And so the final layer in this sort of tower would be maybe we can take all the natural catastrophe risk, securitize it and diversify it into the capital markets more generally. And then you can issue something like a catastrophe bond, and there the value proposition is diversification again, but diversification between the natural catastrophe risk and all the other debt, equity, whatever is sitting in the investors' portfolios that generally speaking should not be correlated with a Florida hurricane or Japan earthquake or anything like this. So in any case, this is how things should function in some ideal world. To the extent that we're seeing problems in the insurance market, it suggests something in this sequence is breaking. And the question that I'm going to try and speak to today is it really, is the thing that's going wrong in this insurance pipeline really in this tail risk part of the market? Which is to say, not necessarily just in like the direct household insurer interaction, but is it that there's frictions in the reinsurance and capital markets, catastrophe bonds part of this pipeline that are actually fundamentally to blame for the high prices we see in the primary insurance market? And if so, what is exactly the cause of these frictions? Okay, so this is what I'm going to try and speak to. And the paper, in a nutshell, is on this slide. So prior to the policy change, that I will say much more about in one line and then in a few slides, insuring natural catastrophe risk, tail risk, was costly. And again, just as a descriptive matter, reinsurance was expensive. Markups were something like 100%, which is to say, to insure an expected dollar of loss, you would pay something like $2 in premium. Catastrophe bonds were expensive. To insure an expected dollar of loss, you'd pay something like $2 to $4 of catastrophe bond premium, essentially. So this is the situation before the policy change. I'm going to study a policy change that made reinsurance cheap. The specific policy change, I'll say much more about it, was the government of Australia coming in to offer public reinsurance with no such markup. So $1 of risk now just costs you $1 to insure. And I'm going to show you that this policy change that made reinsurance cheaper dramatically improved the functioning in the household-facing primary home insurance market. So reducing these markups in the reinsurance market led to lower home insurance prices by something like 20% and increased availability, was a quote even offered at any price by something like 10%. These are going to be the headline results. I'm then going to use these to try and diagnose why climate risk, why this tail risk was expensive in the first place. In other words, can we attribute this fall in prices or this increase in availability to the fact that prior to the policy change, insurers had differential reinsurance market access, and it was really easing frictions in the places those frictions were most acute? Was it that climate risk was really correlated, and that was the friction being eased by this policy change? Was it that climate risk was really ambiguous, and that was being eased by this policy change? Or was it limited competition? In other words, there was insufficient quoting and insufficient entry before, and so the availability piece really is what drove the price decrease subsequently. So I'll speak to all of this as we go. It's perhaps just, and I'll end with some speculations about, to the extent that this helps and we can understand why it helps, what does that say about the limits of private markets and where and how public intervention in those private insurance markets or risk markets more generally should be optimally targeted? Great. And just in terms of where this sits in the literature, I think we're now pretty confident, there's quite a lot of evidence that insurance prices are increasing, and they're doing so most rapidly in climate risk exposed areas. There are many papers showing this. There's some correlational evidence that the increases in primary insurance prices are associated with reinsurance prices going up. And there's some evidence from the catastrophe bond markets that, there's some theories as to why they're expensive. And going back, 20 or so years, there's many different theoretical papers showing why pooling and insuring tail risk is hypothetically supposed to be quite expensive. But my contribution here, I think, is to in a big picture, is to leverage what is a rare sort of natural experiment, exogenous shift to the tailness of the risk. Home insurance went from including a bunch of very concentrated cyclone tail risk to not including it because the government socialized it. And by leveraging this natural experiment, we can I can sort of hopefully provide some of the first causal evidence that it really is the reinsurance frictions that are impacting insurance prices. I can hopefully speak to the mechanisms by which the tail risk, the reinsurance prices were high in the first place. And just forgetting anything else that we might learn more deeply, it is, I think, an evaluation of a novel but increasingly relevant, with proposals in the US that I actually heard the other week, policy solution to these insurance market frictions, specifically this notion of public reinsurance as opposed to public insurance, many examples of which we've seen in the past. Okay, so that's the very high-level summary. Any questions before I dive into institutional details and what's going on? Okay, fantastic. Okay, so the three things that are worth understanding, or worth making sure we're on the same page about, are the three different layers. Well, three of these four layers in the idealized insurance diagram I showed you before. So first, the insurance layer. We're going to be studying home insurance in Australia. And I just want to highlight a few important facts, specifically in contrast to US home insurance markets that are necessary to keep in mind. So in Australia, unlike in the US, insurers can set whatever prices they like. You don't need to go to the state regulator and get pre-approval to raise prices for home insurance as you do in the US. In contrast, the regulation is not about prices. It's really just about capital adequacy, making sure that insurers have enough capital buffer to meet, a tail shock. And that's usually defined as you have to have enough capital to stay solvent if a 1 in 50-year loss hits your portfolio. In Australia, home insurance policies cover essentially everything. They cover wind damage, they cover flood damage, they cover fire, they cover theft, they cover all this kind of stuff. There's no carve-outs like there are in the US, where flood damage is separate, where sometimes wind damage is excluded, and so on. So really should think of these policies as quite comprehensive. The other thing worth noting is that as an industry, it's quite concentrated. This is typical of Australia in general, but in the home insurance industry, 2 firms write something like 60% of the policies. That's a nationwide figure. It's hard to know the exact figure for the specific part of the cyclone exposed part of the country, but I would suspect it's no better than this. And this is in contrast to the US home insurance market, in which it's not typically thought that concentration in the insurance market is a first order problem. In Australia, it plausibly might be. This isn't to say, and this is unrelated to today's work, but I think a general point that I think it's relatively uncontroversial to say that the reinsurance market is extremely concentrated, almost by definition. And that's true, if you're a US insurer going to the reinsurance market or an Australian insurer going to the reinsurance market. But today I'm going to speak to, can we ease competition frictions in the Australian insurance market, which there's reason to suggest, reason to think might be present. Right. Okay, so that's the first layer of the risk tower. Second one is reinsurance. As we know, reinsurance is just insurance for insurers. A typical contract is going to be some sort of stop-loss contract on a portfolio. So a local Australian portfolio will go to Swiss Re, Munich Re, etc., and in exchange for some premium, enter into a contract where if their losses on their home insurance portfolio for a year exceed some threshold, the reinsurer will reimburse them for some or all of that exceedance. Now, reinsurance ideally offers a value proposition by diversifying off Australian cyclone risk versus California earthquake risk versus European flood risk versus life risk and medical risk and all sorts of other things. But descriptively, again, it doesn't seem to be, working as ideally as we would like. Reinsurance is expensive. As I mentioned, for every dollar of expected risk you want to reinsure, you end up paying something like $2 in premiums, or put another way, if every dollar in premium you pay in, you only get about 50 cents back in terms of claims. And obviously, they need to make some sort of profit. But this same markup in insurance is something like 20%, as opposed to something like 100%. It's, there's a lot of scale here. There's not a broker fee to be paid like there is in insurance. So it's not entirely clear why fixed costs are so much higher in reinsurance that would explain this markup. Again, it's really, I would love to do more research about exactly why reinsurance is expensive, but the exact reasons for it are less relevant today. It's just worth noting that there is a markup, and the policy change we're going to study is one that introduced cheaper prices where there was no markup. Yeah, as I said, lots of potential reasons. I'm not sure we really know the answer to this. Okay, fantastic. And then the final layer in this risk tower are catastrophe bonds or other insurance-linked securities. So a catastrophe bond allows an insurer, but typically a reinsurer, to sell some of their tail risk into the capital markets. And mechanically, a reinsurer may issue a bond covering their Florida hurricane exposure. Some investors will buy the bond for, say, $100. They put $100 into an escrow account. The money sits in this escrow account. It's invested in some safe asset like treasury bills. If there are any losses, if there are any hurricanes, those losses are paid for out of the $100. If there's no loss, the investors after 1 year or 3 years receive their $100 back, plus whatever coupons have been earned on the treasury bills, plus some sort of spread to compensate them for the risk, the fact they could have lost their $100. So again, this sounds like a good idea, because the natural catastrophe risk being insured by these bonds is, by most estimations, uncorrelated with what's in these investors' typical portfolios, uncorrelated with equity markets, uncorrelated with debt markets. Nevertheless, they seem to be expensive. So the market's small. Catastrophe bonds on issue about $100 billion versus reinsurance is about $1 trillion. Insurance is about $5 trillion. Those latter two numbers are US specific. A typical bond, you pay it's a $100 bond, but it has an expected loss of $5. And for that insurance that you expect to lose for something you expect to lose $5 on, you have to pay a risk spread of $10 to $15 on top. This is where this 200 to 300% markup came from. These expected losses are actually well calibrated. If you look in the last 10 years, the catastrophe bonds do lose about 5%, or whatever the number happens to be. But nevertheless, investors are still demanding and receiving risk premiums of 2 or 3 times that. Okay, so anyway, That's a sort of risk tower. Different policy responses have been tried to try and reduce prices in the consumer-facing insurance market or increase availability. So we all know that there have been many different, especially in the US, public insurance programs. For example, the US Federal Crop Insurance Program, the National Flood Insurance Program. There's not to say this can't work, but they have historically seemed to lead to have become subsidies, have become over-subsidized and led to, at least anecdotally, overdevelopment in high-risk areas and under mitigation in those same areas. Other types of policy responses that have been attempted are, as I mentioned earlier, just direct price regulation, such as what US state regulators do. There's some nice work now showing that, for example, the California state regulators' unwillingness to let insurers there raise their prices has contributed quite substantially to the insurance market collapse in California. And to the extent it hasn't collapsed, it's because they're being subsidized by home insurers, policyholders in other states that have more or less stringent regulators. I don't think we think either of those necessarily are good outcomes. I certainly don't. The final, second to last category of policy response we've seen are what I'm calling insurer of last resort, run by the government. So here you should think of, Florida Citizens or the various FAIR plans. The California FAIR plan was in the news last year. Basically, they say that if you're a homeowner and you can't get quote unquote reasonably priced insurance from a commercial carrier, you can go to Florida Citizens or the state FAIR plan and they will sell you reasonably priced insurance. Again, I'm not saying this is inevitable to this model of insurance of last resort, but the best examples we have of these have ended up setting prices also way too low and are functionally insolvent, and to varying degrees have sort of cannibalized the private market as a result because they're so cheap. So this is to say that there's potentially room for some policy innovation in this area. And what I'm studying today is a new type, relatively new type of intervention of policy response, public reinsurance. So the leading examples are, I think, UK flood reinsurance program that's been in effect for about 10 years. There are TRIA, which is a terrorism reinsurance public pool in the US that was created shortly after 9/11. There are actually many other terrorism pools that followed. And the particular program I'm going to study today, which is the Australian cyclone reinsurance pool. And as I said, I think we have much less evidence on their efficacy, and I'm hoping to provide some of that in this paper. Great. Okay. So why does Australia need a cyclone reinsurance pool? Well, it's because Australia is exposed to cyclones, which are exactly the same as hurricanes. They're just called cyclones in the Southern Hemisphere, hurricanes in Florida, and typhoons in East Asia. But yes, there are three main hurricane or cyclone exposed areas in the world: the Caribbean, sort of Florida basin, the sort of southern tropical area centered around northern Australia, and then actually the most severe is East Asia, sort of Philippines typhoon. What did the government do to try and deal with this cyclone risk? Well, in 2022, the Australian government created this cyclone reinsurance pool. And what it actually does is it assumes all the cyclone risk, it sort of extracts out all the cyclone risk from home insurance policies. And it does this by promising to insurers that if a cyclone event is declared, and you should think of this as like a named hurricane or a presidentially declared disaster, then the cyclone pool is going to pay out all claims that arise from this cyclone event. Claims of any type, whether they're due to flood, wind, etc. Any damage that's like attributable in a time period to the cyclone event. I think it's important to note that it is not consumer facing. That's why I'm distinguishing between public reinsurance and public insurance. Consumers still buy their insurance and make their claims to their regular primary insurer. The insurers on the back end then go and ask for reimbursement from the cyclone reinsurance pool if the claim occurred during one of these cyclone events. In exchange for this reimbursement against cyclone events or damage due to cyclone events, insurers pay a premium to the cyclone reinsurance pool. This is not free. The premium the insurers pay to this public pool are set using, at least, the government just sort of co-opted all of the insurers' present and historical data, including what they were previously paying for reinsurance. And then they contracted with some climate consultancies, some risk consultancies, to estimate cyclone risk for all the parts, for all the affected parts of the country using whatever the state-of-the-art climate models were. And as a result, oh, okay, I've skipped ahead there. But anyway, so the pricing was meant to be done in as accurate and as accurate a way as possible. The pool, which was legislated in 2022, was mandatory. Insurers had to join this. If you wanted to write home insurance in Australia, you had to join this pool by the end of 2023. There was a sort of staggered entry. This is going to be one of the ways I identify the effects, but 3 joined in January, 7 in July, 2 in November of 2023. And as best I can tell, this was just determined by when their previous reinsurance agreements were expiring, relatively random. And I won't have much to say about any effects here. I just have no data on it. I'll just note that the reinsurance pool was set up so as to maintain and in some cases strengthen incentives for mitigation, for risk reduction. And in particular, there are these tables you can see in the pool's pricing documents that basically say, for every premium we'll get an X% discount, this house will get a 25% discount if the roof is made out of reinforced concrete instead of thatch or terracotta, whatever it happens to be. And so for all the sort of structural characteristics of a house, the reinsurance pool provides incentives in terms of premium reductions to make choices that are risk reducing. Okay, great.
Adam, can I just ask quickly? And this may not be relevant, so just let me know. But if the insurers are doing the paying of claims and then they're just turning around and getting reimbursed, presumably the fund has to audit to make sure that they're not paying out too much or too, on bogus claims or something like that, which you think that might be a design issue. Is that an issue at all?
Yeah, so it's a good question. I actually used to have a line in here. I'm not sure what I did with it. I should have been a bit more precise about the definition. So the definition is the meteorological agency will declare a cyclone. The winds are sufficiently strong, whatever it is. It's this relatively independent agency. And they say, oh, Cyclone Adam began on Tuesday and ended on Friday. And then there's basically quite a lot of latitude given. Almost any claim submitted for damage from Tuesday to Friday plus a buffer zone is going to be reimbursed. And I think, so the question is, I don't know what the auditing mechanism is. I don't know if there is one per se. What I was told when I've discussed it with people is that because they had because the reinsurance pool had access to all the insurers' historical data, they could go back and look, say, oh, okay, when there were these declared cyclone events, when did the claims come in? To what periods was the damage attributed? How much of it is picked up in the actual days of the cyclone as opposed to in the 2 days afterwards? And they set that threshold accordingly, such that so long as, the past was a good prediction of the future, I take it your point is very well taken that it might not be, given they're no longer on the hook for this stuff. Then it was sort of, capturing all of the damage that it was meant to capture. But yeah, that's a great point. I don't have a clear thing to say about the audit mechanism. I don't know. I don't think there is one. Yes, Seema, sorry.
Thanks for the exciting session. This is particularly interesting to me because I have worked on the catastrophic modeling as well and worked on the development of the CAT model as well. Coming back to Professor's question, it is not in favor of the insurance companies to pay as much as they want to, because when the reinsurance comes into picture, either they are in the excess of certain amount of, let's say we have a layer of 1 million. Above 1 million, they are reinsuring. Government is in reinsurance is going to pay whenever the losses reaches 1 million, and anything above 1 million. So there's a different layers, or there's another way to look at it is that the certain proportion of the losses that they are going to pay for. So it's like maybe they agree to pay as a reinsurer, they might agree to pay for 25% of the losses. So it is in favor of the insurance companies also to make their do their due diligence before making payment for the claims. So
Thank you. That's
they might not go with that they can just pay to anybody like that, because their profits are also getting impacted on that. So just wanted to mention on that thing.
No, thank you. I should perhaps have
Yes,
been
please.
a little bit clearer that this reinsurance arrangement is neither the traditional quota share or stop loss that you mentioned. It is not that the government is reimbursing a percentage of every dollar of claim, nor are they reimbursing all dollars beyond some threshold. They're reimbursing all claims, but only in like a specific horizontal subcategory of claims, the ones attributable to these cyclone events. So an insurer could have an entire portfolio, none of which is affected, except one house that is, hit by a cyclone. And then the reinsurance pool is going to pay for all claims from that one house, whether or not the entire portfolio is beyond some threshold, and with no regard to, the insurer is not on the hook for any of the claims for that one particular house. So I agree that the general reinsurance structures are actually quite good at disciplining insurers and keeping, maintaining some of their skin in the game. This one, I think, to Peter's point, is actually quite bad at it because at least for this subcategory of events that are being reinsured, insurers are actually not on the hook at all. So I do think it's a very important distinction. So thank you for bringing that up. Sorry, Seema, you're muted.
Sorry, just in the continuation of that context, personally, I don't feel this might be a good approach because essentially it is going back to the people because government is also spending based on the public funds, which is collected from the taxes from the from their own country people, right? So either this way, either they are paying in the form of the insurance, more payment towards the insurance, which is like of their choice that they want to go for it, how much extent they want to they want to insure their property, or because in the form of taxes they have to pay for it. So it's like enforced liability. I mean, from my perspective, I mean, it's again my own views that okay, I mean, although it decreases the prices of insurance and it gives the people, but I think it essentially the burden comes back towards the public in the form of the taxes. Whereas if we go from the reinsurance perspective, when they develop the cat bonds and all, then again it goes to the market, but it goes to the market who can afford that. But with
Yeah,
taxes,
great.
it's like it's
Seema,
enforced
listen, I
on.
think we need to
Yeah.
let the speaker finish what he's here to
Oh,
say, and then we
sorry.
can come back. Yep, thank you.
Yep.
No, it's a very good segue actually. So my next slide is exactly about pricing. So hopefully this will at least, I'm not sure clear anything up, but at least make my position on it a bit clearer. So the pool is set by statute to be revenue neutral. So if it's functioning well, it shouldn't impose any burden on the taxpayers. In other words, overall, the premiums are set to cover expected costs, but the expected is important because obviously many years there will be no costs, and then some years there'll be very big costs. One of the things I'm going to try to do empirically is to check that this actually was the case. I'll explain how later, but we do find, all the evidence I can find does suggest that this was set correctly to be revenue neutral, and it does not seem to require taxpayer subsidy. This is at the overall program level. However, there were potentials for sort of cross subsidies between high and low risk houses, even if the overall program balances out, built into the program. Potential, I would say. It was never clear exactly if these would actualize. In particular, what the program set out to do was to say, for low and moderate risk houses, the reinsurance pool premium should be similar to whatever the private market reinsurance premium was before the pool. In other words, we're not going to give any savings to the low or moderate risk properties, but we're going to load all the savings onto the high risk properties. They're going to get a reduced reinsurance pool, public reinsurance pool premium because of, one, they're not paying a markup. That's the design of the reinsurance pool as opposed to private reinsurance. But any saving that should have accrued to the low or moderate risk properties is actually going to be passed on to the high risk properties. So really, we'd like to disentangle how much is the direct effect of the pool not charging a private market markup versus, in the case of the high risk properties, how much is just being cross subsidized, if anything, from the low or moderate risk properties. We're generally going to find that like the first effect is vastly bigger than the second one. And so this is really a sort of, reduced markup effect. Is not really, it doesn't seem to be a cross subsidy, but it's worth noting that this is not precluded by the design of the program. Okay, great. I'll say this, I'll go through this relatively briefly. I'm happy to go into much more detail about the empirical methods, but I think the results are more interesting than the methods. But basically, I have two data sets. They're just collected differently, but in both cases, they are home insurance quotes for fixed but essentially randomly chosen houses in a particular region in Australia that is, well, quite cyclone exposed, but there's quite a lot of heterogeneity. The key thing to note about these insurance quotes is that they're quoted for fixed houses and policy characteristics. In other words, I'm not getting quotes or insurance payments for the actual houses that sit at these actual addresses. I'm getting the output of going to the insurer's algorithm, putting in the same house characteristics. This is a 2-story house with a concrete roof, elevated 3 feet above the ground, et cetera, et cetera, et cetera, whether or not that actual house sits at that particular address, and seeing the price that comes out. So the house and policy characteristics are held fixed in every quote here. All that varies is the address, in other words, the geography or the climate risk at the geography. So I don't know what people are actually paying for insurance. I don't know which of these quotes, if any, people are actually buying. But in some sense, that's a feature, not a bug here, because I want to know what's actually the contribution of climate risk, not what are people actually paying for all sorts of other reasons that might mix up risk, house characteristics, policy choices, etc. Great. So anyway, you should think of all the prices I see as just for the same representative house and policy. Okay, great. Again, to summarize here, the 2 ways I try and identify the effect of this quasi-experiment. The first is to compare the high to the low cyclone risk zip codes. To basically say that the reinsurance pool by design is meant to lower prices in exactly the places where reinsurance was previously most expensive. That's in the places exposed to cyclones. And so by comparing what happens in the places unexposed to cyclones, we can see what the general trends are in the insurance market, net those out, and see what's just the effect of easing reinsurance frictions in the places that previously were exposed to them. It's a standard 2-way fixed effects sort of staggered adoption thing. Happy to say more about this, but it boils down to comparing high to low risk zip codes. Yes. The second strategy is to, as I hinted at before, use the fact that some insurers entered before others. And so if we want to, we're basically going to exploit the fact that 3 entered in January, 7 in July, 2 in November. And so we can control for time, time specific or time invariant effects. And we can isolate the difference between what's happened because an insurer has entered this pool as opposed to what's happened because it's just July, by comparing the fact that some entered before, some entered after, and then we can net out the July effect and then isolate the treatment effect. In any case, all the results I'm going to show you are going to use both of these empirical strategies. You'll see them side by side pretty much, and they end up saying the same thing, despite the fact they rely on quite different assumptions. So that's reassuring. Great. Okay, to the results. The first key outcome is what happened to prices. So the first 2 columns are using this differential exposure, this high versus low risk. And the next 2 columns are using the fact that some insurers entered before others. And we can see that as insurers enter the cyclone reinsurance pool, the log of their premium, so this is basically in percentage terms, went down by 22% in the first empirical strategy, or something like 10% in the second. These are actually roughly comparable based on the sort of scaling of these variables. But this is where that original, the 20% number I gave you at the beginning, the headline, you really should interpret as saying the highest risk property in the sample, in contrast to the lowest risk property in the sample, had a 22% additional reduction due to the fact that they're in the cyclone reinsurance pool. So netting out whatever's going on in the lowest risk property, the highest one fell by 22% more. That's that first headline result that I mentioned. The second one is, in addition to what happens to prices, we care about what happens to availability. So we can see in the data, 1, what price do you quote? But 2, do you quote a price at all? And in many zip codes, insurers just will not sell you insurance. And so here, the outcome is a binary variable for do you quote a particular property insurance in at a particular time. And we can see again that when insurers join this public reinsurance pool, the probability that they quote for an insurance policy goes up by 5 to 10%, depending on how you measure it. So this is that second headline number, which again should be read as the high-risk properties are now 11% more likely after entering the cyclone reinsurance pool relative to low-risk properties to even be offered an insurance quote. at any price. Whoops. Okay, so that's okay. I'm only 5 minutes behind schedule. That's kind of where I wanted to get to by the end of 30 minutes. The headline results are prices fell and availability rose. The rest of the paper, which involves more or less detail to get to, but nevertheless the headline results are pretty interpretable, are trying to understand what caused this. So I'm basically going to test all these different mechanisms. Was it the fact that some insurers were particularly constrained in terms of their reinsurance access before, and those access frictions were eased? Was it just a subsidy? I've already told you I think the answer is no, but I'm going to test that. Was it a potential cross subsidy? And then perhaps more conceptually interesting is to what extent can we attribute these price declines to the fact that now there used to be a high cost associated with insuring correlated risk that's now been eased. There used to be a high cost associated with insuring ambiguous risk that's now been eased. And finally, we've seen that insurers entered, in other words, there was more competition, there were more quotes for any given property, and maybe some of the price decline can be attributed to the fact that there are more insurers quoting for that particular property. So I might, take requests basically for any or all of these, or we can just start open-ended discussion, and I can tell you what the sort of outcome is here, even if we don't go into all the details. I'm very open to either.
You're in charge. Just go until somebody asks you to stop. I'm not
Fantastic.
doing that.
Okay. Yeah. Sorry. Comment in the subsidy. Okay. Fantastic. So let's talk about the subsidy. So actually, I've written this as 6 points, but the first 3 are really one analysis. Let's see. So we're trying to distinguish between these effects on lower prices being due to the fact that maybe the government just got the pricing wrong, set the public reinsurance pool prices to be 20% too low, and that's explaining a 20% fall in prices, as opposed to, oh, actually the reinsurance market was too expensive, and that's being eased without it being a subsidy. So as I said, the cyclone pool has to be actuarially fair, or at least that's what it's legislated to be. And in particular, they had access to all the insurers' historical reinsurance pricing. So they could, the cyclone reinsurance pool, at least, they also had CAT models, but they could see what the insurers used to pay and benchmark their prices against that. Still, they might have been overly optimistic. Maybe the catastrophe models were wrong. Who knows? Subsidies can creep in. So what we're going to do is compare a subset of the insurers who were Australian subsidiaries of large foreign insurers to the rest. And in particular, these 3 insurers, which I forgot to name here, but they're Allianz, another subsidiary of Allianz, and then the local subsidiary of Liberty Mutual, already had access to actuarially fair reinsurance just by, internally transferring the risk from their local subsidiary to their European or American parent company. So they already had, and you can see this in the balance sheet data, basically, at cost reinsurance. And so if we want to see whether this was a subsidy, we can ask, if the prices fell for these insurers that already had access to zero-cost reinsurance, that would be consistent with the subsidy. Then everybody's just, being handed money by the government. If not, and these and these insurers who had access to at-cost reinsurance, their prices didn't change very much, that would be consistent with this being priced actuarially fairly. And in fact, if all the price effects came from the insurers who did not have access to this overseas parent who would take the risk off their hands at cost, that would be consistent with the story that it's really reinsurance access frictions being eased. So what do we do? What do we find? We basically do the same analysis before, but we distinguish the price effects between the domestic and the foreign insurers. So this first row says that the price effects for the domestic insurers were even bigger. That it was the ones that were not subsidiaries of foreign affiliates had price falls of 20 to 35%. This second row, which should be added to the first row, says that the foreign subsidiaries had price effects of negative 29 plus 39. So if anything, a positive price effect. There were no price declines. You cannot, statistically the same as 0 price effects for these foreign subsidiaries. So what is this saying? It's saying that all of the action, all of the price reductions came from the local Australian insurers that did not have overseas parent companies to whom they could transfer the risk at 0 cost. They were the they were the constrained insurers who had to go on the open market for reinsurance previously and bargain and pay these high markups. That's where all the price reductions are coming from. And in fact, the insurers that previously had zero cost reinsurance or zero net cost reinsurance, there were no effects on them. So this is consistent with the pricing of the pool being accurate, at least compared to what Allianz Germany used to charge Allianz Australia. And further, it's evidence for the fact that it's really frictions amongst these constrained domestic insurers being eased that's driving these effects. Okay, great. Competition mechanism. Okay, great. Let's skip around. All my pretty diagrams going to waste, but that's fine. Okay, competition effects. So as I said, the home insurance market was very concentrated, especially so in these cyclone-prone areas. The biggest two insurers had something like 60% market share. The question we want to speak to is, did insurance availability drive down prices? Okay, so the regression we want to run is basically asking, how does cyclone risk change over time in general, and how does it additionally change when there's a new competitor in my zip code? That's what this final term is here. The problem is the act of a new insurer entering a zip code is obviously not random. It's endogenous with a bunch of, other market conditions. There might be profit on the table. In particular, I'll talk about it in a minute, but it could be correlated with other things. So what we're going to have to do is find some instrument, some sort of third variable that exogenously shifts new entry without affecting, while being uncorrelated with any of these other zip code specific effects we might be worried about contamination with. So the instrument we're going to use, let me go back a second, is we're going to look at, before this cyclone pool came in, how many insurers were offering insurance in a particular zip code. So this is the proxy for how competitive was a zip code before. So mechanically, if a zip code had very little competition before, it's going to be more likely that you see new entry in that zip code than in one in which there were already a lot of insurers before. That's not an economic statement. That's just, basically small numbers are more likely to get bigger than large numbers. The econometric issue that may arise, the exclusion restriction for this instrumental variable, is that we need, for this strategy to be valid, we need that any difference between the pre and the post prices that we want to look for to not be related to whatever the competition situation was prior to the policy, except through this variable. In other words, we need places that this strategy essentially compares zip codes that had a lot of competition with zip codes that didn't have a lot of competition, and say, okay, within the zip codes that didn't have a lot of competition, some of them got new entry, some of them didn't. What we're basically assuming is that amongst all those zip codes that didn't have competition before, they're roughly comparable, except for the fact that then some of them happen to, some of them happen to get new entry. Now, I don't think this is strictly true. It's, for example, it's violated by correlation. I haven't shown you this, but this is mechanism. The 3 slides that I just skipped over show that the reinsurance pool had a big effect controlling for risk on more correlated versus less correlated places, controlling for the level of risk on more correlated versus less correlated places. And so this is all to say that like these high competition or low competition places might actually be proxies for high or low correlation, and that might be contaminating this whole thing. So I do a bunch of other analyses where I interact both this entry analysis with the correlation analysis and the ambiguity analysis. And this all turns out to remain true, but this is the kind of thing to have in mind. In any case, so I'm running a similar sort of regression, but now we're looking at what's the price reduction effect in places with no new entry, and what's the additional price reduction effect in places that do have new entry. And you can see that, okay, the effect in places with no new entry is about 17%. This is like most of the original 20% effect I showed you. And then there's an additional 2 to 10%, depending on the specification, that's specifically attributable to the fact that to an insurer entering a zip code. So this is to say that there is some evidence, not perfect, but some evidence that it's not just the cyclone pool having a direct effect on pricing, but it's the cyclone pool inducing new entry, increasing competition, having a secondary knock-on effect on pricing and stuff. So that's what this analysis is aiming to
And
show.
what's the theory by which that would happen in the first place? So you would now have reinsurance access that you didn't have before. So that would tend to mean like the domestic, not the subsidiaries. Is that who's doing the extra entry? It's just like their costs are lower. So now it's because they don't have to go to the international pool, they can get cheaper government reinsurance. So they're more willing to go to new places.
That's exactly it. Exactly. There are a bunch of places that are just really exposed to this cyclone risk. The domestic insurers judged were too risky, or if they had taken that policy on and tried to get private reinsurance, it would have just been too costly for them to compete. Now they can, so to speak, compete on a level playing field with the subsidiaries of the foreign companies who already had cheap reinsurance, so now the domestic insurers can enter these high risk areas, and the foreign subsidiaries can't get away with charging the relatively high prices they were charging before. They have to reduce it by a little bit more.
And I'm sure you did this already somewhere. I just didn't see it, or I don't remember. But so can you look to see whether the people doing the entry are in fact the domestic people who are not subsidiaries?
Yes. Sorry, I don't think I have it in the slides, but it's in one of the appendices to the paper,
Okay.
and it's
Yep.
concentrated there. Yeah. Sorry, Travis and Seema in some order. I don't know.
So this is perhaps a kind of silly question, but do you hear a lot of stories in the US about these insurance companies being particularly slow moving when it comes to any kind of shift like this, like it's, as I understand it, this model presumes that when this treatment was, or when this new reinsurance was available, that all the insurers kind of instantly change their underwriting standards, change their pricing, and maybe that's true, but I'm a little skeptical, and I was wondering whether you have any anecdata about that, or any sort of time series that would show that how efficient they were in terms of incorporating this into their pricing.
So I don't have here's the time series. I think, yeah.
Great.
And remember that I said 3 insurers entered in January, 7 more in July, and some more in January. Some more in the latest November. I didn't collect the data at regular intervals. But this is just showing you that, yeah, some insurers entered and reduced their prices. Some more insurance entered and, prices went down even more, and so on. So this is not with insurer specific. This is the whole market. But, at least you can see that there are insurers making, in the case of a couple of months, 10, 20% price changes. I'll just say that, I completely agree with the characterization of the time lag in the US case. But a lot of that is because of the fact that you need pre-approval, and you need to collect historical data to justify the pre-approval and this kind of thing. Here, you can just change the price. There's truly no barrier to doing so. Great. Sorry. Yeah, Seema.
So from my perspective, I think that one of the insights to decrease in the price is that now the insurers are not worried about the initial impact, in the sense that you mentioned that from Monday to Friday, or Friday to Monday, certain period, that insurers can file the claims to the reinsurer, that is the Australian government, and then they will reimburse that money, right?
Yep.
So whatever the initial period where the most of the losses are going to happen that are reported in the initial period, all the insurers need to worry about the period after that. Let's say for the first 5 days, that has already been taken care of by the Australian government, and if somebody files after 5 days, then how much they are supposed to pay for. So if they take that, the impact from that, then obviously the responsibility on them to pay for the claims is lesser because most of the claims are already paid by the Australian government.
Yep.
As per the reinsurance policy. So since their liability is less, that's why the prices goes down from that perspective. And obviously from the competition, will more and more people want to gain more on that part.
No, I completely agree. And I guess one way to, if I'm understanding correctly, if the insurers were fully on the hook for those damages in the first 5 days, in other words, prior to this policy, they had no foreign reinsurance, then this would be a massive effect, because they just go to being completely exposed to being almost not exposed at all. I think that what we're actually seeing is like some intermediate case where almost all of these companies had private reinsurance before. They were protected in those first 5 days and in the days afterwards. They were just protected at a very high price. And so we're seeing, I think, more of an effect from the price of protection changing than from the very existence of the protection going from on or off, going from off to on or on to off. Just as a related point, although I don't have much more to say about this, you're completely right that the trigger, the definition for these claims to be reimbursed by the pool is the cyclone event plus 48 hours. Insurers still do and still contract with private reinsurers to try and get some protection in the days after that period. The modeling that the government did, and I think has borne out, was that something like 80 to 85% of the claims were captured by the cyclone period plus 48 hours buffer. And so definitely the private market is still involved for that remaining sort of 15%. But for that 85%, we went from very expensive costs of reinsurance protection to quite cheap, relatively cheap.
Great. Karen Collins had a question in the chat. I don't know if you can, Adam, you can read that?
Oh, sorry. Yeah, I lost it for a second. I'll just read it out to everybody.
Or maybe Karen wants to chime in and ask it live. I don't want to put her on the spot.
Sure. So I work for the American Property Casualty Insurance Association, APCI. We're based in the U.S., represent roughly 2/3 of the property insurers here. And this is a topic that we've seen proposals made at various state and federal level for different reinsurance risk pools. And our view of that is that it doesn't actually address the long-term issues that we are seeing as far as the underlying root issues that are really driving a lot of the market challenges and certainly the media coverage of it. We see, climate risk is making insurance where it's not ever going to be available. It's uninsurable in certain areas. And we don't believe that. Certainly there is a lot of challenge in the market, but we view it as a temporary market cycle right now. When you look at the underlying cost factors of inflation and you look at some of the other growth of communities in high-risk areas and certain other factors, there's a lot of increasing costs. And when you look at the spikes in inflation in particular with the recent catastrophes in the last 5 years, 7 years, whatever time frame you want to look, all of that led to losses that surged far higher than insurance prices. And that's true for both reinsurers and even more so for the private insurance market. And what we saw was a substantial erosion of capital in the initial early years of the pandemic that really led to a lot of companies having to de-risk to a degree until they could re-strengthen their capital. And we're seeing that happening. As you know, reinsurers can make those changes right away. So we saw very sharp increases in costs in, I think it was 2023. We're seeing more of that happening now with the private insurance market. And what you're seeing is that as those prices are closing the gap to what costs have been, you're starting to see capacity opening up. So my point here is what I put in the comment is we don't, in our view at least, think that a government reinsurance pool is necessary because you have to look at what is the main issue that you're trying to address. Most have suggested it's more for availability. We don't think that's the case. We think it's a temporary market cycle that when you look at even all the recent industry news articles, reinsurance trends are softening. When you look at January 1 renewals, we're starting to see price declines. We're seeing reports of opening up more capacity. Some of that varies with the top end of, your high severity perils like hurricane, cyclones, earthquake. It's a little bit different with more frequency driven perils, the secondary perils like severe storms that we get in the US and wildfire, et cetera. But generally, capacity is expanding, it's opening up. So this is where I question, what is the root underlying issue you're looking to address? Is it truly availability? Or is it more of, again, a market subsidy to address the affordability challenges for some of those highest risk areas?
That's a very good point. And I do want to, I suppose it's a few things. And I'm responding, this is going to sound a little more like, I'm disagreeing a bit more than I actually disagree, just because, me saying I agree 6 times is perhaps less interesting. So what did I want to say? Yes, that I completely agree that like one of the most notable feature about reinsurance pricing is its cyclicality, is the fact that like capital seems scarce enough that, you know, the price of reinsuring exactly the same property in 2023 is very different to 2019. Now, I would call that a bug, not a, you know, not an inevitable or natural market feature. Um, and in fact, one of the better rationales I've seen for government intervention in these markets is that governments have a sufficient pool of capital to be able to smooth out those market cycles, and therefore the fact that you know, not have to impose capital shortages and the associated reinsurance costs on the people who actually want insurance in the very first place. So I view the fact that like this additional pool of public capital coming into the reinsurance market that could potentially smooth out some of these business cycle effects as even, you know, as potential additional or sort of interpretation of the benefit of this of the benefit because it can allow for capital constraints to be eased and this pool of capital to be widened. But I completely agree that seems to be what's going on. I think I won't flash it up again, but it is interesting to note that 2023, as you know, as you said, was a time of particularly hardened reinsurance markets where in general US reinsurance prices and I believe insurance prices themselves were up by like 10 to 20%. But I was showing you declines of about 20%. And so there's, you know, this is to say that you can buck the trends of the global reinsurance hardening or softening cycle with extra capital. But I just want to close by agreeing and saying that I do not think this is a panacea to all our problems. I think we can reduce prices by 10% or 20%. We can perhaps attenuate future price increases as climate risks increase again. I think the fundamental problem is that most people don't want to pay the fair price for the risk in the places they live. There has been, you know, for various reasons, like a lot of construction in Florida, a lot of construction in risk-exposed places. And there could well be political pressure to turn a public reinsurance program like this into a subsidy scheme because people already in place and people who are in place have political power and so on and so on. I view this as saying, even if you don't bow to those political pressures, you can help somewhat. But I completely agree that the longer term issues of, you know, we should probably really incentivize relocation or risk mitigation or these things that actually reduce risk as opposed to just paying for it after the fact. You know, that's clearly the first order problem here. Pradeep?
Hi, yeah, so I have more of a comment than a question. You mentioned that the expected losses were 5% and the risk premium on the cat bonds were more like 10 to 15%.
Yep.
That would make sense to me for a highly skewed distribution of losses, that risk-averse investors would expect a higher premium than what the expected losses are. And the fact that the government is coming in and pricing it at fair value, that also makes sense to me because government is not a risk-averse investor. It can actually go in as a risk-neutral investor and just charge the actuarially fair price. Although if I were setting this program up, I would charge something higher than actuarially fair price because you want to set aside some capital for, you know, if things don't turn out as expected. And if you charge more than what it turned out to be, you can always release that extra premium back to the insurance. Insurance.
All right, so one comment, and then I think this segues well into what I wanted to end with. Actually, I have only a minute left. Yeah, I agree this need to sort of build up a capital buffer is there. It's worth noting in this program and in the US proposals analogous to it that I've seen, there's essentially just a treasury backstop in place. So that even if this is going to break even over 10 years, you know, if you get the bad year before the 9 good years, the general revenues from the government will cover the shortfall. It's in that sense that they think they don't need to mark up above actuarially fair so as to build up a capital buffer because they've implicitly got the entire treasury's capital buffer in the background, but you know, that's a positive, not a normative statement. And just on your point about, you know, the effects and the justification for all this, let me conclude by, you know, the interesting sort of future questions that I think you've just touched upon are, you know, what are the limits of government intervention? As you say, the government can price anything risk neutrally, and if the insurers are implicitly being risk averse or tail risk averse, and the government comes along and says, we'll be risk neutral, The government could therefore offer savings on all sorts of products. The government could, could sell us cheaper auto insurance. They could sell us cheaper everything, right? Presumably we don't want that. And so thinking systematically through what are the limits of government intervention, exactly what risks and under what conditions should this comparative advantage that I agree the government has in terms of pricing risk neutrally and having a much bigger pool of capital to smooth out business cycle fluctuations is a sort of important step to take. Another way of putting it is, instead of the government necessarily assuming all the aggregate risk, whether or not that's a good thing, is there some way for them to put in place, I'm not sure, better modeling capacity or other things, so as to catalyze a private market for aggregate risk without them assuming all that aggregate risk themselves? Anyway, thank you very much for listening. This has been a lot of fun.
Oh, thank you very much. That was absolutely fantastic. And are you willing to stick around a little bit in case people want to talk?
Yes, I'm very willing. I might ask if I can run to the bathroom for 1 minute.
Please,
then,
of course. Okay.
Give me 1 second.
I will now entertain everyone by singing. No, I will not do anything like that. Travis, do you have a soft shoe routine you can do, or we'll just wait for him? That was very sweet. Anybody who needs to leave, especially students who want to go, you're welcome to take off, but please stick around if you want. Anybody have questions so I can just start a queue, or you're just waiting to hear what everybody else has to say? Travis, you got no shtick?
I wish.
Okay. I don't.
Can try to teach, just got done teaching promissory estoppel, can try to do that in 30 seconds flat.
Oh, good luck.
Yeah.
I could try piping in some Spotify music, maybe.
You can play music in Zoom, but you got to get that going for next time.
All right, I can do it now.
You know how?
Yeah, I do. Let's see. All right, here he is, back.
Bearing with me.
No. Thank you very much for coming back. All right, so the floor is open. People stuck around. What does anybody want to talk about?
I'm interested to hear more about the catalyzing aggregate, like private aggregate risk markets. That I realize takes you beyond the scope of this paper, but we're at the end of the hour, and so maybe we can just wax hypothetical for a minute. Do you have thoughts about how that would work?
About analyzing them?
The last bullet
Catalyzing.
on the slide that you like, that, how could we catalyze private markets? Yeah.
Okay, so to speculate wildly, there's an interesting paper, perhaps you've seen, by Meredith Fowley, Judd Boomhauer, some people who study California home insurance markets, and they managed to figure out, what models and how sophisticated the models of the different insurers selling home insurance in California were. And they found that, like, Allstate had this incredibly sophisticated model. Somebody went to Allstate, that Allstate made money. Whenever somebody went to these other insurers, these other places made money. And there's a theoretical reason why this happens, but in any case, there was a lot of, and therefore the insurers who had these bad models realized, okay, we've got to charge higher prices because we've got this winner's curse. We keep getting the wrong people, keep getting selected against. So this is a way of saying that, like, differences in the modeling capacity was a reason for some insurers just leaving California because they realized they were not able to price as accurately as Allstate. And so they had to get out of there. And even when they did come up with the price, by definition, if people bought it, it usually meant they had gotten it wrong because Allstate was pricing higher than them. And so one way you could catalyze a tail risk market is by standardizing or normalizing the models everybody has, the information everybody has. And so if, for example, there was one very cutting-edge catastrophe model that everybody thought was the best, I'm not saying this is likely or possible, but if you could do such a thing and then made that information a public good, then insurers could go and, sort of compete on that level informational playing field in some sense. I mean, information and model is always given as like one of the canonical examples of a public good, because everybody redoing this modeling process over and over is a complete waste of time and resources. And so as a public good, or as a provision of this public good, it could be I'm not sure how much it would help, but it's sort of one idea to try and level the playing field and allow insurers who are small and up and coming and don't have the sophisticated modeling capacity of Allstate to nevertheless get a foothold.
But you might sacrifice some dynamic. I mean, the profit motive says I have a reason to figure out a better model so I can outcompete everybody else. Where if it's a monopoly model, then there's not much of a reason to improve it, or not as much of a reason.
No, 100%. But Allstate has an incentive to keep improving.
Yep.
Although in a dynamic sense, if they've knocked everybody out, they can then just sort of exploit. They might still, the model might still be good. The Allstate incentives to improve their model might still be high, but their incentives to extract monopoly rents because of their better model is also very, very high. And so,
sure.
And it's hard to know what is better or worse.
Who else? Anybody? So can I just, this is maybe not entirely fair question, but it seems to me like the woman, now I'm blanking on her name, Karen, I think, who had to leave, was saying, well, we don't think we really need this. I'm a little surprised. It's not fair to talk about her in her absence, but I'm a little surprised that they wouldn't like a public reinsurance option, or maybe I don't know. But is the case even stronger in the US in the sense that we have state regulation that makes pricing decisions much more rigid? So the need for reinsurance is going to be higher because when you can't price risk as you would like to because state insurance regulators won't allow you to, or will limit how fast you can adjust or something like that. So having better reinsurance is even more beneficial in a world where you can't adjust your prices rapidly or fully. Is that wrong?
I think it's a double edged. It's you're sort of damned if you do, damned if you don't. I mean, in many, I know only anecdotes here, but some state insurance regulators, when you were applying to increase your prices, they would not allow you to use a reinsurance price increase as a valid justification. It all had to be sort of historical losses. I don't know how prevalent that is anymore. I just know that this is something that changed in California basically during the wildfires, when they went from reinsurance is not a valid cost input to reinsurance is a valid cost input. So if you're trying to sell, prior to that, if you're trying to sell insurance in California, I mean, you don't want to have it on your books because you can't increase prices fast enough because the price increases are very regulated. You don't really want to reinsure it either, because if that price of that goes up, you can't increase, that's explicitly not a reason why for you to increase your prices. Whereas if you actually have it on your books, at least at some point a loss gets registered and maybe you can increase your prices. So conditional on the state regulators allowing reinsurance, as a valid cost input to a request a price increase from, then I do agree that like the necessity to send some of this risk or centralize some of this risk is much stronger. Yeah, not sure. Sorry, yeah, I've the reinsurers I've spoken to, I mean, it's hard to know. Obviously, it's maybe there are some on the call and I'm about to offend them, but monopolists are usually not going to say regulate me. And my impression of the reinsurance industry, even though they're not that profitable, is that they just descriptively there are 3 of them, or there are 5 of them, and it's a natural monopoly. You need scale to compete. The entire value proposition is scale and diversification. And in other natural monopolies, we regulate them because we realize that we need the scale, but we don't want the market power that comes with scale. And so in this case, it would have to be Germany and Switzerland regulating them or something. And because it's such a global market, it's very hard to coordinate those regulations. Yeah. And so some sort of public alternative that implicitly disciplines them, I think is the next best thing you can do to explicit, because you can't do actual natural monopoly regulation as you would do for a utility.
Yeah. Great. Well, okay. I think we've kept you long enough and I don't see any more questions. So can I just thank you again? Fabulous talk and presentation of difficult material with incredibly lucid. And if you have further questions or comments, you can reach Adam by email at NYU. So
yeah, I didn't put my email up, but
that's cool. They can find you.
Fantastic.
Thank you very much, Adam.
Thank you, guys.